Good morning, everyone. Thanks for coming today. I appreciate it. We're going to do our Pension 101 training for all of you, and there are enough new slides this year that we may take a little bit of time as we go through some of them, and if you have questions, feel free to ask them. One of the things that we're going to get to you before the day is out is a little recap of all the changes to the health insurance that'll be taking effect January 1. And you're all getting this ahead of everybody else. It's going to be in the next Vanguard as a special pull-out section, but we thought if we're going to be talking about health care or trying to get a handle on health care, it's probably a good idea to actually put those changes in your hands right now. So before the day is out, we'll have those for you. And that's, at least in terms of the MARSP section of this, that's probably why there's, it's not probably why, it is in fact why there's some changes to our presentation. So with that, I will turn it over to Gary from Williams & Company.
Great. Thanks, Mark. I'm just thrilled to be here, and we're going to treat this as if you folks are the prospective retirees. So I want to start by saying thanks to MARSP for being proactive in having us come down, and I'm enthusiastic about being your MARSP presenter today. Being proactive in terms of answering questions ahead of time. We are here to help you determine exactly whether or not you're ready for retirement and to lead you through some of the pitfalls, some of the exciting things that are in store for you as you make plans for those retirement years. As he said, I've been through this for real. I'm a retired school teacher, and hopefully some of the insights that I've gained I can pass along to you folks today. So we'll just begin. In the MARSP presentation, there is always an evaluation form. So at any time during this meeting we have today, please take time to fill this out, and I believe they'll be collected by the end of the presentation by either myself or the volunteer that is here today. The Office of Retirement Services is the overall hood that oversees our pension systems. And what we need to understand right off the bat is that MIPSRS, the Michigan Public School Employees Retirement System, is just a portion of that overall hood. The other state employees are listed here. You have the Michigan judges, the Michigan State employees, the Michigan State Police, and then the school system. The school system is by far the largest group, of course, but so that you understand where we fit in, we have the list of all the other groups. MIPSRS. What does MIPSRS really do for us as potential retirees? Well, there's a two-prong approach here. MIPSRS will provide us with the financial side of the retirement benefit, being the pension, and as well the health insurance side with all the attributes listed there. And we're going to cover both of those in some detail today in this meeting. Retirement income goals. This is a question I think that most potential retirees have often in pre-retirement years is, how much do I need to retire? And will there be enough? And from where will it come? So we're going to look at that idea a little bit. Economists tell us that whether or not we're going to have enough sort of depends on what we've had while we're working. So the left bar over there, the green bar, is going to represent our income prior to retirement. Economists tell us that if we can attain somewhere between 70 and 90% of that income going into retirement years, we should feel pretty comfortable about that. And, you know, it's common sense. By that time, we hope that the mortgage is pretty well paid off and the kids are, those college expenses are starting to wane. Not always the case, not in my life anyway, but that's our goal, okay? So we're going to look at that in terms of a retirement goal from all sources of income as we enter those retirement years. Here's your MIPSRS pension portion of that goal. And this, by the way, refers to pretty much a full-scale, fully vested, could be a 30-year employee, can expect to see between 35 and 45% of that income being met by the pension system itself. Another question we see or we hear often is, well, how does MIPSRS calculate my pension? And the defined benefit Formula is right here in its general form. We take the total number of years of service multiplied by our average salary, which is different things for different teachers at this point, and multiplied by the multiplier. Okay? And as you're aware, after the 2013 Senate reform, the pension bill this past fall, that's the number that was in question. That's the number that we had to decide about with those 4 options. We multiply that and we come up with the annual income under the option 1, straight life benefit for a retiree without a survivor benefit. Pension qualifiers. How is it that we can qualify to retire? What are the ways that we can do this? Well, there's full retirement, and that means a few different things. I would look at full retirement and age 60 and up sort of as full retirement. It means different things for different people. If I'm a basic member, full retirement for me means I've attained the age of 55 and I have at least 30 years of service in Michigan. Okay? I have at least 30 years of service. If I'm an MIP member, that means I have 30 years of service. I'm eligible for full retirement benefit. Now, we can also reach full retirement benefit by being age 60 or over and having at least 10 years of vested service in Michigan. Doesn't mean your pension's going to be the same as someone with 30 years, but at age 60, whether we're MIP or basic or pension plus, we're eligible for that full retirement benefit. And there are 2 other little subcategories there. Early reduced is a pension benefit where we have to be at least age 55 with 15 or more years of service, and we decide to retire somewhat early then. We haven't qualified for the full benefit. We can take what's called an early reduced benefit. The reduction, though, is permanent, okay? And it comes to the tune of 6% reduction for every year prior to the age of 60 that you retire early. So if you're a 55-year-old retiree but didn't have the years of service to qualify for full retirement benefit, that's 5 years early times 6%. That's going to be a 30% reduction in your would-be full pension for life. Okay? It lasts forever. The deferred benefit plan, I like to say that's really for someone who's got another career in mind, sort of, because there are a few issues there that we need to talk about. Number one, you defer the taking of your pension and health care if it's available to you until you're age 60. Okay? And then at age 60, if you are eligible for health care, it's going to be with an increased subsidy that you pay. And it's a 10% increase in the subsidy for every year that you retire early, up to your 30 years of service requirement. So that's something to look into and be careful about when you choose, or if you choose, to be a deferred retiree. The formula, again, as we spoke about a minute ago, is different things to different retirees. Based on the type of employee that you are, we're going to break that down here for just a second. If I'm a basic member, which I incidentally am a basic member, okay, so I know this one. The average salary portion of the formula is based on your highest 60 consecutive months of salary. Does not have to be your last 60 months. In fact, for me, it was not. I coached varsity basketball until my last year of teaching. The last year I did not coach, but I taught, so my income went down far enough so that that particular last year was not included in my 60-month consecutive highest average. Okay? Going across for the MIP people, a little different, a little better average. 36 months average, highest 36 months consecutive average pay for your average, final average compensation. And if you're a pension plus employee, we're back to the 60-month average. We talk about the second line there being years of service. Again, basic means you're 55 with 30 years or more. MIP, 30 years or more. And for full health care options, the pension plus people would be age 60 with at least 25 years. The thing that we end up dealing with a lot of times is the bottom row here, the bottom line. Do we get a raise in our pension? Well, it depends. I don't. I'm a basic member. Okay? Well, there's a potential 13th check, I should say, and we'll talk about that in a minute. As a basic member, my raise would be based on a possible bonus check that may or may not come at the end of the investment year in terms of the investing process of the pension funds. The MIP people have a guaranteed 3% non-compounding, call it cost of living if you will, increase in their pension pay every year. Okay, the MIP folks do. And the Pension Plus educators, that's gone. We're back to no increase. So we multiply down those columns and we get the first year gross pension. There have been a lot of changes, as Rich was alluding to, a lot of changes recently in the pension system and the rules and so on. We're just going to run through a few of these quickly here a minute. From 2008 through 2011, here are some of them. The impact of buying years of service on the subsidy. It used to be a situation where if you bought years of service, it didn't matter. Okay? If you purchase years of service after 2008, you will have to buy your own health care for those years that you purchased that it allowed you to retire early. Okay? If you started the contract to purchase for those years prior to 08, you're in. You're under the wire. That's one change. They increased the MIP contributions on the last category of the graded MIP cost function. I believe that was in 2010. Working after retirement has changed. There's no more the ability to just go back to work for the school district, earn as much as you want, and still retain your pension. We now have a 1/3 rule where you can earn up to 1/3 of your final average compensation as an employee, and it has to be directly contracted through the school district. We have the Pension Plus is a relatively new group of people. I believe that began in 2010. If you're hired after July of 10, you're in the Pension Plus group. And then something we're all excited about is the pay that we give to the Health Insurance Trust Fund, 3% of our salary, in order to retain eligibility to have health care provided for us through the system when we retire. Okay, that is new during these years as well too. And then there were some tax law changes. As you know, beginning in the 2012 tax year, our pensions are now taxable not only at the federal level but also at the state level, and here's the rule on that. Okay, we want to take a look at this a minute. If you were born before 46, you're not impacted by this state taxation, but if you're born between 46 and 52, you are, or might be. You have an exemption for the first $20,000 of your pension, or 40 if you're married, from being taxed at the state level in this group. If you're born after 52, like I was, I don't get that exemption until I reach age 67. And at that point, there's an exemption for a portion of my pension at the state level in terms of taxation. So we may see questions about that. 2012 changes, the reform bill, as it was finally established, gave us some options as educators. We could maintain the 1.5 multiplier, but we had to pay an additional cost to do it. That 1.5 multiplier in the pension formula we saw earlier. We could maintain that 1.5 multiplier for the first 30 years of service. This is option 2 on the screen. And then let it fall back to 1.25 for any years going forward from that. It's sort of a pay-as-you-go plan. You'll pay more into the system for the first 30 years of service and then see a reduction after that, but your multiplier goes down as well. Or we could have chosen, as of this past February, to reduce our multiplier in the formula to 1.25 for all years of service after that date in February going forward. And that one is, we call that the default option. If people did not make a choice, that's what they got. They saw no change in their check, but their pension in effect did take a little hit. So we want everybody here to understand that issue especially. And then option 4, if you chose that one, you said, I want to freeze my pension benefits today, but I want the school district to deposit 4% of my salary into a pension account for me, a separate fund, so that I can draw on that during retirement time instead. You have your pension benefit, but your years of service, your final average compensation would be frozen as of the time you made your choice for number 4, the option 4. We're going to explain to them what their options were so they can identify where they are right now. I would say to you, the biggest question about that right there is probably if I had selected option 3, let's say, and I know I defaulted, I let the state decide for me, I know that my check has not changed at school. But automatically, what that really means is that my pension has dropped a bit. Because had I kept that higher multiplier, my formula would create a larger first-year pension going forward when I retire. Now the multiplier on the years after 2012 here, or February of 13 actually, are going to have a smaller multiplier, so my pension's lower. So have they asked that question? Have they done a little homework and determined where they are, and have they done something about it? That's what they have to answer in their own mind. Yeah. So we would get them some help to find somebody to help them with their own numbers. All right, just quickly, what did it cost? We talked about this added cost. To keep the multiplier at 1.5 back in February, if you're a MIP member, whatever you were paying into the MIP system, whether you were MIP fixed or MIP graded, that amount would rise to a flat 7% of your salary going forward into the MIP program, okay? And that will keep your multiplier at the higher 1.5%. If you're basic, remember, you never were paying anything into the system. You were paying 0. That went up to a flat 4% as a basic member in order to keep that higher multiplier. And Pension Plus members, of course, they're not a part of this issue, so they're easy. Again, here's that formula. This would be based on someone who had chosen to keep the multiplier at 1.5, and you can see that's in the formula there. This is a description of those that opted to take number 3 or didn't opt anything and they got number 3. Here's an example of what it looks like when we determine their pension based on the split formula. The pre-2012 years are multiplied by the higher 1.5% multiplier, and the post-2012 or post-February years are multiplied by the 1.25%. Together, multiplied by your average, your final average compensation, and that's getting you the straight life pension benefit first year. The DC plan, the option 4 plan, how is that calculated? If you chose option 4, as we said, your pension formula was frozen at that point, but you have a 4% employer contribution from your district going into a 401k account, and that would, incidentally, you would retain the 1.5% multiplier on your previous years of service, but you get no credit for future years of service. No credit in the formula for future years of service. This, again, is sort of our warning slide, you might say. What about what I did as an individual employee? If I chose option 3 or did not elect, if you did not elect a choice, this is the choice you did get. The default, your multiplier went down as of February to 1.25% for the rest of your career. Okay, those years going forward. And I think that's something that we got to make really clear to everybody we are in front of. There were some changes in health care just recently. 2012 changes on the pension reform bill go this way. If you were hired prior to 08, you are now part of a 80-20 plan. 80% subsidy by the pension plan itself for health care, and you and I will pay 20% then of those health care premiums in retirement. That changed from 90-10 prior to the pension reform bill, and now it's 80-20. We pay 20% as retirees of the health care premium. If you chose to opt out, there was in the pension bill, there was an option to opt out of health care. And you're going to have people at your meetings ask, well, what does that mean? What did I do? You mean I don't have health care anymore as a teacher? No, it does not mean that. It means that they opted out of eligible or being eligible for health care when they retire through the system. Okay? What that means then is that they no longer are going to be charged the 3% that would normally go into the health insurance trust fund to maintain that eligibility. They no longer will pay that. But it also means that they're on their own for health care when they retire. Now, in lieu of that, what happens? Well, there is a 2% employee contribution and a 2% employer match into a health care fund, which will be a pool of money or a pot of money then that they can use to draw from to make health care premiums when they retire. So, if they opted out of health care on the 2013 Pension Reform Bill options, it means that they opted out of the eligibility for full health care through the system when they retire. They're still under their school district's plan while they're working. If you're hired since 2008, since July of 2008, you're in a different group. We're under what's called a graded subsidy. And the system will give you a 30% subsidy after 10 years of service. And after that, they increase their pay portion, their subsidy portion, by 4% a year. So you might say, well, how long does a teacher now then, who hires in after 08, how long do they have to work before they catch up to the rest of us that are grandfathered into the 80-20 plan? Well, if you start with 30% at 10 years and you got to get up to 80%, you need to grow another 50% of subsidy. At 4% a year, it'd be about another 13 years or so. So you could tell folks that by the time you reach 23 years of service, you're about maxed out in terms of your benefit, at this point anyway, with the healthcare system at the 80-20 plan. Now, for those that were 65 or over and retired by this past January 1, they're under the wire. They are under the old 90-10 plan. A few things about Pension Plus, and Rich alluded to the fact that Pension Plus is a whole new animal, and that's true. There are lots and lots of issues there that need to be educated. We have to have education on this. This slide describes a portion of it. And here, employees are going to automatically contribute 2% to a Pension Plus fund, and their employer can match up to half of that into that same plan. So there's lots of education here with the new teachers that needs to be done. Yeah. Okay. An example there of the contributions that an employee might make, the 2% I should say, $800 going in, and the employer matches up to $400 of that for $1,200 a year. We'll look at a vesting schedule in a minute here. All right, as we talked about just a second ago, in terms of the employer contribution, there's a vestation schedule. You can see that 50% match going on here, where the employee puts in $800 a year, the employer $400, and as you can see, after 2 years, there's a 50% vestation, meaning that money is really then available to the employee. 75% after 3 years, and this is the employer's part that's becomes vested, and also then at 4 years, $1,600 or all of it in terms of the Pension Plus fund. We put this slide in every presentation that we do. This one is so crucial because it's a life-changing decision. And it actually looks like this, I believe, still on the website, where you, as a prospective retiree, you go to that website and you say, I'm going to fill out the paperwork online to retire. There's a one-time cast-in-stone decision that you make, and that is, how do I want to receive my pension? Very, very important that the people we meet with in these meetings get this. This is crucial. We look at straight life, which means I'm going to receive my pension only as long as I live. and medical benefits only as long as I live. When I die, I pass away, there is no residual benefit of any kind to the beneficiary. The other three are survivor benefit options. And we'll look at those in detail here in just a couple of minutes. But those will pass on not only a portion of the pension that you receive to your beneficiary, but also the health care. Speaking of beneficiaries, who may be one? We get a lot of questions on this. And at this point in time, it's assumed sort of, if you have a spouse at the time, that they will be named as a beneficiary. And if you name someone other than your spouse has to sign off on that saying, hey, it's okay. It's okay. I don't need to be on there as your beneficiary. But beside that, you can choose a child, a parent, brother or sister, and dependency is not required. At this time, we can't just name a friend as the beneficiary of our pension. That is the list as we know it. So, as I mentioned, we want to look a little bit more at these four options quickly here. These numbers, by the way, are monthly income numbers that are based on a $40,000 final average compensation employee. Kind of takes the average of everybody. And under this option here, if you were to choose straight life when you go to do your retirement forms, you'd bring in $1,500 a month. It would drop to $1,100 if you had chosen the 100% survivorship option, but you can see that your survivor would receive your pension if you die first. They continue to receive $1,100. Going on down the line, you have some hybrids of that. You have 75% where you receive a little bit more again in your pension as the employee, but if you die first, your beneficiary receives 75% of what you were taking in, and so on with the 50% option. The thing to note here is that in all of the survivorship options, the health care is there. There's a yes in each one of those boxes. The health benefit is passed on. A lot of people will ask, well, what if just the wrong thing happens here? What if I choose one of those beneficiary options, because I'm thinking of my wife, let's say, and she goes and dies first? I just shot myself in the foot. Why did you do that? Well, thankfully, the state does not penalize us for thinking of someone else here. There is what's called the pop-up option, which means if I had chosen one of the lower three, the survivorship benefits, and then my beneficiary is not available because they pass away first, I'm allowed to pop up to a straight life for the rest of my life. Now, the thing about this is, MIPSRS does not watch the obituaries for you. You have to call the Office of Retirement Services and let them know that your beneficiary's passed away and you want to be placed back at straight life, and they'll do that. I got to tell you, I had someone leave a meeting. They got up and left a meeting once. It was a friend of someone who was still working, said, I got to go make a call, because they had forgotten that they could pop up. They actually left the meeting and went to call the ORS. It's true. It's true. So which one of these options might we choose? A couple things to think about here. With this one, we kind of nicknamed the honey, I love you option, because so often this is the one that gets talked about most when husband and wife are sitting next to each other. The 100% survivorship option. But there is a big difference in the amount of benefit between them, between that and straight life. So let's take a look at that in a minute. As you saw, the benefit dropped from $1,500 a month in straight life down to $1,100 a month for the 100% survivorship. That's $400 a month, or $4,800 a year, or if you're healthy during retirement for at least 30 years, that's $144,000 of retirement difference on making that one decision. So it's crucial that you look at the numbers. Who might take these options, and how can we help people? Well, some common sense, I think, things here. Who might take straight life? Well, someone who's single. They don't have a beneficiary to work with or need to. Someone whose spouse doesn't need our health care because they have fantastic health care themselves, and it's hard to find that because our health care program is still excellent. I mean, it's really, really good. Or if I'm married to another school employee, we both have that option for a health care benefit. a great time to choose straight life because we'll each have our own option when the other passes away. The other options here involve life expectancy issues generally. Sometimes there are special needs where we just definitely need to prepare for our spousal retirement package. There are ways to maximize the pension, and we'll look at that in a little bit. New spouse benefit allows you to make a change, and you've got to be a little bit careful about this. It's only about spousal beneficiaries here. It allows you to add a new spousal beneficiary if your spouse who was living at retirement time dies before you, or if you're single when you retire and then get married after, you can add a spousal beneficiary at that time. Of course, there is this we call it an anti-gold digger clause here, which says you have to wait 180 days. Between 180 days and 1 year, you have a window at which time you can add that beneficiary or change that beneficiary. If you start with a non-spouse beneficiary, you're not allowed to make changes like that. This is only for those that have a spousal beneficiary. There are times, folks, when you're just going to have to say, you know what, you should call the ORS on this one. Because they're the folks that are going to have the final gavel decision anyway. And that happens from time to time. If you alert the ORS that your beneficiary is passed, they're not going to go back during those years when you enjoyed life with your beneficiary and give you the pop-up money for that. They're only going forward. Back to the retirement goal idea. We were looking at this earlier and we found that the pension portion is going to bring in about 35 to 45%. There are other options though as well. Social Security comes into play at some point. We'll talk about that in a minute. Or we can increase our upfront pension flow with something called the equated plan. And we're going to deal with that here. Should I take the equated plan or not? And what is the equated plan? This happens to be what it looks like on the paperwork when you choose to fill out the forms. There's a checkbox that says, yes, I want to take the equated plan or not. And let's look at what that is a minute. Best way to explain that is to look at two possible retirees. On the top, I would call this the standard retiree who at age 55 decides they're going to retire with full benefits. They've got their 30 years in, maybe they're basic, we don't know. And let's use the same dollar amount. $1,500 is their monthly income beginning when they retirement. Your checks arrive late in July, the year that you retire. And that will continue until we choose to take Social Security, where we're going to get a little boosted income due to Social Security benefits. This particular employee chooses to start at 62, and so you'll see a $1,500 per month income until they reach 62, and then it jumps up to what? $2,600 a month for the rest of their days, we'll say. Give or take some Social Security increases that they might encounter. However, if that same employee had chosen to do what's called the equated plan, they're basically going to front load their pension with higher income until age 62. And this is the way it works. They would possibly have a $2,000 per month pension income, but at age 62, and this is a key thing, whether or not they choose to take Social Security at 62, the amount they would receive at 62 is computed, and this particular person took it, so the income is there at $1,100, but their pension from that point on is automatically reduced by whatever they took in Social Security income at 62. So it is truly equated. You're going to have an equal income every month for life at what? $2,000. The pension went down to $900 because Social Security took part of its place. Okay? A lot of times we say, well, what if I don't take it at 62? What if I choose to take Social Security later? It doesn't matter. They're going to reduce your pension by the amount you would have taken had you chosen to take it at 62. Okay? And you say, well, who would do such a thing? Well, folks who maybe have longevity issues, maybe have special needs that require funding now, and they just can't wait for income to develop later, new sources with Social Security. They need it up front. There are three significant ages that we deal with in talking about Social Security. We have to talk about reduced benefits and what does this Social Security full retirement age mean. We know that at this point we're allowed to start drawing Social Security at age 62. Okay, it's a reduced benefit at that age. And in the old days, I say old days, I think it was before 2010. I don't know. Anyway, prior to this, you've heard of people saying, well, I get Social Security at age 65. Not the case anymore. Now there's a window at which we name full Social Security age or full benefit age. And that ranges anywhere from 65 to 67, and it depends on when you were born. For me, I was born in 1957, and my full age is 66 and 6 months when I'm eligible for full Social Security benefits. So you'll have to deal with that. The benefit that you receive will rise the longer you hold off, the longer you wait to receive the benefit, through or up to age 70. Once you reach age 70, my take is you might as well take it because you're not going to get any increases for waiting any longer than age 70. Here's a look at those full retirement ages based on when you were born. You can find yourself up here. If you choose to take it before this age, you'll receive a reduced benefit. Here's the schedule for the reduction in benefits. I can find myself here at 1957. If I chose to take it at 62, my benefit would be down to 72.5% of what it would have been had I waited until 66 and 6 months. And when you look at this, you'll find that people will want to see themselves on this, find out where they're at. So we're building our way to that 80% goal or that 70 to 90% goal of retirement income. It leaves a portion to still be attained, and that's going to come from us, from our own savings. Okay? Could be as high as 25 to 30% from our own savings. If you look at that educator or that employee that was earning $40,000 in their final average compensation, then these are the dollar amounts they'd be looking at. In order to maintain that 80% goal, they'd have to maybe draw $10,000 to $12,000 a year from somewhere else, from their savings. Well, fortunately, Michigan Public Schools offers us a plan to accomplish this, called the 403B Savings Plan. And how does this work? And we want to talk about that for just a minute. In a 403B savings plan, money is deferred pre-tax from your salary into the 403B fund that you set up. And the contributions right now for 2012 were $17,013. In 2013, it's $17,500 for anyone who's under age 50. And at age 50, there's a catch-up provision. We can add $5,500 more tax-deferred dollars into our account if we're 50 or over, plus a special catch-up if you haven't contributed the maximum amount over the last 15 years. It takes a formula to determine this one, but we can put up to $23,000 a year tax-deferred before we even hit that last $3,000 optional catch-up. So it's a very good deal, meaning that you're going to pay tax on these dollars when you draw them out as a retiree, which generally your income tax bracket is going to be a little lower than it is when you're earning full-time wage. You'll get questions about purchasing years of service. Why would you? Well, it can increase your pension, and it could help you retire early. You got to be a little careful here. Lots of types of ways to buy in credit as a school employee. We have the universal buy-in. You can buy up to 5 years of credit this way. There are credited years of service for non-public education, maternity or paternity leave time. This is the cost for an educator, an employee, to purchase years based on what we know now until 2014 arrives. It's based on your years of service and your age. And you can find, for instance, someone who's 53 with, let's say, 21 years of service. It's going to cost them 20.5% of their highest salary to buy another year of service. Okay. Believe it or not, there are other types of credit that can be purchased in. If you work for the state of Michigan, things like, I think, Michigan State Park employee, that kind of thing, I think you can purchase credit on that. Here's our list. Out of system means from another state. You can actually purchase these types of credit. If you're on workers' comp, I think that period of time you're allowed to purchase that back in. How do we do it? Well, there are a couple of options. You can actually write them a check. Not necessarily the best way. That's going to be after tax, okay? Write a check for the amount to pay for years of service. You can set up a tax-deferred purchase plan. It comes with an 8% interest rate. Or you could your employees could transfer funds out of their 403B account. And it maintains then a tax-deferred purchase. So that's probably the best deal, although there may be instances where it would be better or more helpful to do it the other way. But these are ways that you can purchase years still. The warning here. You have to have 2 years of service before you can start to purchase anything, and I think you can only purchase a year for a year after that. You can't have been in there for 3 years and purchase 5, that kind of thing, as an employee. And if you're hired after this past September, in other words, a new hire, purchase of years are out of the question. So anyone who's a new teacher this year for the first time entering the system, not allowed to purchase years. We talked about this a little bit earlier. If you're purchasing years now or have started the contract after 2008, for the years that you retire early due to that purchase, you're going to be responsible for 100% of the health care subsidy at that time. Okay? Those that purchased prior to 2008 got under the wire, but until they would have been eligible for full retirement. Good point. So if you went 5 years early because you purchased 5, you got to buy that health care 100% for the first 5 years. An example of what it costs you as a retiree to buy your own health care, listed here. You can see it adds up to just about $16,000 a year if you were going to do the purchase completely of your health care benefit. Where else could I receive income? Well, as you know, we now can go back to work in a Michigan Public School reporting unit. Provided we contract directly with them, we can earn up to 1/3 of our final average compensation that we use for that formula. To my knowledge, this does not work if we work through a third-party contractor. We have to contract directly with the school district itself in order to make that happen. So there's another way to increase your income in reaching that goal for retirement. Or, as a retiree from Michigan Public Schools, you can do anything you want. You can go to work and do something else, earn as much as you can to supplement your income that way, and still receive your full pension benefit. On working after retirement, the rule is stated right here, something that we ought to talk about. If you ever earn over that 1/3 of your final average compensation, you've earned too much, you're going to forfeit your ongoing pension benefit and your health care portion. Or if you're working through a third-party contractor, not directly contracting with the district, they'll suspend your health care and pension benefit that way as well. So you have to make sure if you go back to work for school that you're contracting directly with the school district. This slide tells all of us where to go to check on our current statistics in terms of the ORS. On the ORS website, you have the My Account tab, and if as an employee you want to see what the system has for you in terms of years of service and all of that sort of thing, up to date, that's where we need to go, and I'd encourage everybody to go there. The last slide that I have to review with you is this, and two things here. One is an invite to, in fact, by filling out the little registration card that you'll receive or have in the packets, I think, generally at the meetings, it'll bring everyone a 1-year free membership in MARSP, as well as a chance to have a free LifeTracks pension analysis done for them. And we really promote both of those things. The LifeTracks is a great way for them to see what their streams of income would look like with their current 403B, with their current years of service, with their current projected date of retirement and so forth, going on into retirement. So thanks for your time.